Environmental issues. Part A. Assess the macro environment of an organisation using PESTEL. The external environment can be analysed in terms of the broad factors which affect all businesses, or those relevant to a specific industry or market. The macro environment mainly includes broad factors that could affect all businesses. For example, political or economic factors or technological changes are termed as macro environment, as they impact all the businesses in a particular region. These can be assessed using PESTEL analysis. Organisations can use PESTEL analysis as a framework for analysing the general business environment, also known as macro environment. It can also be used to access the opportunities and threats present in the environment. These opportunities and threats in the environment can be accessed by analysing 6 key factors of the PESTEL analysis. Under political factor, we analyse government decisions and policies such as changes in the competition policy or consumer policies. Economic factor is analysed to know the impact of economic growth, inflation, interest rates, tax rates and foreign exchange rates in the industry. Social aspect is considered to understand the demographics of the market, like changes in culture and taste, which can affect consumers as well as workforces. Technological changes have changed the way of working in a particular industry or the demand of a particular type of products and services. Environmental analysis is required to know the environmental regulations, climate changes and pollution policies in the industry. Under legal factor, changes in laws and regulations such as employment law, data protection and health and safety law are analysed in the industry. Part B. Assess the implications of strategic drift. Strategic drift can be defined as a scenario when an organisation's strategies fail to address its strategic position to the external environment, particularly in response to environmental change, leading to a deterioration in the organisation's performance. Environmental change is inevitable. To survive such changes and to avoid strategic drift, companies need to respond effectively to opportunities and threats present in the market. Strategic drift not only diverts the management, but also damages the business momentum. It can also waste money, valuable resources, and, more importantly, time. Therefore, it upsurges the overall operating cost. In reality, at times strategic drifts take organisations far away from accomplishing competitive advantage. Thus, it is very essential for organisations to make sure that they can avoid redundant strategic drifts or strategic actions. Part C. Evaluate the external key drivers of change likely to affect the structure of a sector or market. Organisations or industries more generally need to take advantage of opportunities that arise in the external environment and respond to the threats it poses. As such, changes in the external environment can act as drivers for change. For example, car manufacturers moving towards producing more environmentally friendly cars in response to customers' concerns about carbon emissions and pollution. The stimulus for organisational change can be driven by either internal or external events. Events are sometimes referred to as triggers. External triggers, also known as drivers of change, may include the following factors: increasing competition, changes in customer tastes and buying behaviour, social changes such as demographics including logo, income and gender of customers, changes in the economic cycle, recession or growth, political and legal pressures, new laws, regulations and tax rules, increasing use of new technologies, internal and mobile technologies. Part D. Explore, using Porter's diamond, the influence of national competitiveness on the strategic position of an organisation. Assessing the opportunities and threats which are present in different countries can be particularly important for multinational companies that are thinking about investing in a new country. However, another key consideration in the investment decision could be how competitive the country is. Michael Porter observed that some nations' industries are more successful than others. He identified 4 key factors that collectively determine a country's attractiveness for a given industry. The interrelated elements that can be used to assess a nation's competitive advantage are mentioned below. Factor conditions relate to a country's resources. These can be categorized as basic factors and advanced factors. For example, basic factors are natural resources, climate, semi-skilled or unskilled labour. These are basic preconditions that are needed for an industry to be successful, but, by themselves, they do not provide any sustainable competitive advantage. In contrast to basic factors, the presence of advanced factors can help to promote a competitive advantage. Some of the advanced factors are infrastructure, communications, higher education, and skilled employees. A tough domestic market is likely to encourage competitiveness, as firms have to produce cost-efficient, high-quality goods to satisfy the requirements of their domestic customers. The experience a firm gains from meeting domestic customers' needs will then allow it to compete successfully on an international scale. Similarly, industries need to be supported by a good local supply chain, which contributes to quality and cost advantages. Cultural factors, social attitudes, and management styles can all lead to a competitive advantage in certain industries. Intense domestic rivalry among firms means they need to perform well to survive through cost reduction or quality improvement and innovation. The intense domestic rivalry may also encourage firms to look for export markets.